Hello, everyone. Welcome to the weekly roundup. Today we will cover interest rates, inflation, and market sentiments. Hello, Ben.
Hey, Eva.
How's it going down there?
Going great. Traffic wasn't too bad today. I think everyone's on holidays this week.
Oh, that's a good one. It's been it's been a lot this past few weeks, traffic.
For sure.
Yeah. Yay, summer.
Yeah, that's it.
Okay, we're gonna start things up with the Fed shakeup. What does the recent resignation of Kugler and the rise of Trump-aligned figures like Miran and Bullard signal about the future direction of U.S. monetary policy?
Well, it's a great question. I mean, I think ultimately what we saw Trump do in his previous term versus what he's doing now is more of the same. He's trying to put friendlies into place that will hopefully lead it in the direction that he wants it to lead. You know, lots of things start to pop up in your research and feed when these types of things happen. And yeah, the Federal Reserve was started in 1910 by a bunch of bankers and the Treasury. And so it was set up to act as an independent body. And it's come into question over the years, certainly as Yellen's gone from, head of the Fed to Treasury Secretary, and there's kind of this intermingling between government and the Reserve. So I have to think it causes more thought that we're getting less independent and maybe a little bit more connected, but ultimately it probably results in, if there is a shakeup, which continues until Powell loses his seat, it probably results in looser monetary policy, which means lower rates. The risks of the inflation individuals are that inflation starts to run away on us if we decide to uh, provide easy money again, and you start to see prices move up more quickly than is comfortable. I think there's the other side of the argument is that's already happening because of the tariffs that he's put on. I think there's a bit of a fear maybe we get a runaway inflation. I still really believe that's not the case. I think technology is really causing things to fall in price. So I'm not overly concerned about it, but there is a risk that, and I say a risk, there is a risk that rates come down quicker with the new leadership. But really, what that typically means is higher asset prices. So that would mean stocks, bonds go up in that backdrop.
Okay, we're just going to touch on inflation a bit further. US inflation came in a bit mixed. CPI for July was milder than expected, but the producer price index was significantly above forecasts. What does this mean for future prices? Could this, filter through to consumers? What do we see?
Yeah, so I think there's that held belief that the Fed was going to keep their inflation number at 2%. And so they've been really fighting hard to hold the line on cutting rates. And if you read through a lot of what they saw, is they said, we're not super worried at 3% inflation. So they've kind of changed their wording more than anything. It's not that inflation has come down, it's the fact that they've given inflation a bigger band within which they're willing to take action on. And so I think your answer is right. There is probably some risk that inflation continues to tick higher. If there's more inflation for the producers, then likely that flows through to the consumer. I think that the other thing that central banks worried about is they're worried about the jobs number is creeping up. The job losses is creeping up. So I think they're willing to say, forget it, we don't care about that anymore because the economy is slowing faster than we anticipated, and they're going to cut anyway. So, after the report that came out, um, we saw likelihood of a cut move up to 94% likely after the report. So the market interpreted it as a positive. Not sure it was a positive, but that's what the futures market is saying. Rates are coming down in the September meeting, which is, about a month away now.
On the Canadian side, markets appear divided on the likelihood of a rate cut at the
Mm.
September meeting. What are your thoughts?
So, I mean, our economist team think that the market's a bit offside here. If the US is going to cut and our economy is slowing faster and our inflation's slowing a bit faster as well, that we're a bit surprised that it's not priced in more than the coin toss right now. So maybe we'll see as we get closer that number starts to move down, but the likelihood's quite high that they cut in September. Our economics team, though, changed their forecast slightly, where they anticipated 75 basis points in this calendar. I think that's probably going to push to end of Q1 before they get the third cut. So our team thinks they cut in September, and I think the market's presently underpricing it. What does that mean? Probably some upside for bonds if that reprices back to closer to where the Fed is right now.
Okay, great. So there was some recent data showing Canada's unemployment is rising. And I mean, combined with this higher tariffs, what are the economic implications for Canada in the coming months?
Yeah, so it seems like we're having some challenges, and that has to do with many things. Obviously, we had a pretty good market, pretty good economy, for a number of years, and now that we're starting to see things get a little tighter, we're seeing AI certainly taking jobs. That's happening already. We've seen Carney come in and quietly cut government jobs, so they're not grabbing headlines right now, but certainly jobs are being shed there as well. So I think that probably the many things like that coupled is causing that unemployment rate to rise. And we saw, youth unemployment at a real high level, and I think that's 17 to 25 is that bracket. So that's not great. So as Canada tries to repivot and get away from, their constant relying on the US, it's ultimately resulting in the jobless numbers increasing, and that's another reason why we think rates continue to come down is because our economy is slowing, jobs numbers increasing. These are things that the central bank can see easily and realize that in order for them to get in front of something, they need to react sooner rather than later.
Okay. Just final questions for me. Any
Mhm.
interesting stats on the trading front? I know that majority of earnings have been released, so did we see anything interesting there?
Yeah, there was a lot of different data points out through this earnings period. Continued tremendous amount of talk about AI within a lot of the earnings calls. So that's resulting in, to your point, you're resulting in lower headcount, and so jobs are being shed, but it's resulting in greater profits. So profitability was better. I think it was yesterday we saw Google's Chrome revalued at something like 35 billion. And so you're seeing as AI gets integrated into these huge data hogs like Google and Meta and all these companies, it's resulting in greater profits for them at this point. Some of the materials companies as well had big beats. So the miners and metals companies had big beats, and some others had big misses. So I'd say quite a bit of variability in the earnings numbers. And the one thing that surprised me a bit was Shopify's numbers came in quite strong. And so they would be, small, medium, some large enterprise as well, but used to be a bit of a litmus test for me, kind of small mid market because they service so many of those businesses. It came in better than expected. So there's a lot of mixed numbers coming through, but yeah, quite a bit to read, and AI continues to be on the talk of all the earnings calls.
Right. I see the charts.
Perfect. Just bear with me for one moment. Just let me know if you can see it.
Yes.
All good?
Yes,
Okay.
all good.
All right. We are recording this around 1 o'clock on August 14th. So anything that happens after this, we're going to talk about next week, of course. All right, let's jump into this. And so Lots of things to talk about, but I know we touched on this a bit in our early conversation, but I think it's important just to think about rates, and it's really one of the key pieces that I get questions on a continuous basis. So this is US, Canada, Eurozone, Japan, and the United Kingdom. Great big markets to follow, just what's going on with rates. And I'd say the key piece to your question around rates and how they come down and when they come down. So if we look at where the market's currently pricing in over here, we're seeing 30 basis points of cuts. That's what the market's pricing in right now. We think it's probably 75 by that point, which is April of next year. And so market's pricing in that. So really, if the market's mispricing something and an outcome happens which we anticipate, ultimately that results in higher bond prices, at least on the short end. On the longer end, it's really going to be more contingent on what happens to the economy. And so we've been talking on that, and we think the economy is slowing. Then if we look on the Eurozone over here, we're seeing rates continue to come down there, not as aggressively because they are lower than most of the other places that we follow, with the exception of Japan. And then if we slide over to look at the US numbers here, as I mentioned, that's about a 1% cut between now and April. So market's starting to price that in. And again, if we get something higher or lower to that number, it's going to really move prices on the bonds. So that'll be something we continue to watch closely. And so, if we get around this time, which is when we would start to get our new Fed chair in May of next year, you could see that number moving down dramatically if they believe they need to stimulate the economy. I do think the trade and tariff war that we're going through ultimately is going to result in pain next year from an economic perspective. What happened is the markets, we can discuss that on a second point, but from an economic perspective, I think that's where we'd see the slowdown there. In the Japanese market, we still think rates creep higher. And then if we look at GBP, which is over here, we think rates come down about 50 basis points. So, when you're thinking about crosses, so for example, if you're looking at Canada and the UK, if you look at this here, we anticipate rates will, this is what the market's anticipating anyways, that rates come down 42 basis points. And if this outcome plays out, ultimately what it means typically from a currency perspective is Canadian dollar should outperform the sterling a little bit in that backdrop because of the interest rate differential. So your question just about earnings. So this is the TSX, and TSX is a little bit less of a deep market than in the US. So if we look at these numbers, there'll be some big swings, and we haven't had a big reporting yet on healthcare and materials. So that's been coming out this week. So those numbers have been coming out and providing some updates. So 64% reported, 61% beat. Um, so 32% miss. So that's interesting for me, anyways, at least, as a contrarian, which makes me start to think about things and signals and so on and so forth. My instinct would be to look at these numbers and say, okay, do I look at communication sector, energy, utilities in this case, and say, okay, those ones are missing. Some of the utility companies continue to get hit and under pressure. So you're looking in these three areas and say maybe there's opportunities. All three are good dividend payers. Maybe the energy companies have been oversold at this point, so maybe there's some opportunities to think about from that point of view. So on the US side, as Eva said off the top, most of them have reported 91% will be pretty close to 100% by the end of this week. So 91% reported, 80% beat. Again, similar if we look at energy, materials, those are the two sectors that have missed more on a percentage basis. And so again, maybe there's opportunities in that space, which ones have done quite well. So you look at financials, you look at, we'll say, IT, information technology. So those would be the Metas, the Googles, Microsofts. So big beats on those side tends to not result in good returns over the next couple of quarters when you have these big beats because they got higher hurdles to live up to. So it start to make me think about what do we do from a positioning perspective here, and is there an opportunity to say maybe lock some profits in or do something a little bit different? So this is great, I think, to look at and think back because I look at these numbers every day and just thinking about, there's this hubbub for 2 years probably about inverted yield curve. And so when you look at this here, this is where we were a year ago versus where we are today. And so we had an inverted yield curve for a long time. And now we've gone back to when the Bank of Canada cut rates dramatically, right? So now we're starting to see we'll say, a more normal yield curve. And so there's two parts to this. One, I say traditional economists would think, well, a naturally sloping yield curve means positive economic activity, things are going well. But if you look at any of the past recessions that we've had, we've gone from inverted to a period of a naturally sloping curve. Typically, is a signal more for a recession than just the inversion itself. So I think we got to pay attention to this. On the U.S. side, hasn't been quite as dramatic. Certainly, the move from here has been, but they haven't started yet in earnest with cutting their rates at this point. So last one, the opinions expressed here are not necessarily those of National Bank Financial. As always, if there's anything that you want to discuss, certainly talk with your financial advisor or reach out to us, and we're happy to expand and provide more details if necessary.
Okay, thank you, Ben.
Welcome.
So what are we watching this coming week?
Well, I think one of the things that I'm watching is certainly we've talked, I think, a bit about precious metals and the companies themselves. So we had some of those material companies beat, seeing a lot of 52-week highs in those names here, starting to make me think about what do we do at this point as we're starting to see these levels reset. Maybe it makes sense to trim or take some profits. And again, I think it feels like week four, at least, of me saying there's more things to sell than buy. And so continues to be my view and thesis. And so I'd be looking at where are the opportunities to maybe trim, take some profits, and or what is on sale. And so I've started to uncover a few names that I think look attractive and doing some more research on that side of things. But for the most part, there's been more to buy and to sell. August, market's been lighter, volume's been lighter. And as we start to head quickly towards September, which will result on everybody back to work, lots more volumes, potentially more volatility, start to think about what do we need to do to make sure portfolios are positioned for the back half of this year.
Sure, sounds good. Thank you. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeat will be in the caption of this video and in your email box. For clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again for listening and have a good weekend ahead. Bye.
Thanks, everybody. Bye.